Check, check, check. One, two. Check. Check, check, check.
Check, check. Morning. Check, check. Very good morning, all of you. I hope all of you are well rested and ready to start the day with a very cool weather. We're going to start with what the 2026 year has been. It's been a year of many surprises, from the war in the Gulf to various state government elections. And in the face of so much of uncertainty, only one thing has been certain, which is the downward drift of the public markets. With indices down about 10% so far in the year, and share prices of the top IT companies much less by more than 2x or 3x than the Nifty and the Sensex. So through the course of the day, we are going to be deep diving into various challenges and opportunities, if any, and see if there are any surprises that our esteemed panel members can show us with the insights that they're seeing on the ground. The inaugural session and panel will focus on macro issues relating to the alternate asset class, followed by a growth capital mid-market segment. And post-lunch, we'll deep dive into sectors and then deep dive into the world of venture capital. We'll have plenty of time for interactions, both during the panel discussions and during the networking time in between. We also want to thank our sponsors for the opportunity to help us organize this event: Ascent Capital, Basis Fund Services, Stakeboard Capital, TVS Capital, Specially Invest, and Resurgent India to make this event possible. We also thank our knowledge partners, AZBN partners, Shardul Lamachan Mangaldas, Touchstone Partners, and Trilegal. With that said, for the stage, let's start the day's proceeding with a presentation of what the data says on the state of private equity and venture capital in the almost first half of 2026. So there's a presentation to your left. Just an introduction about venture intelligence. So venture intelligence, as you know, has been around for more than 25 years now. And we have private equity database, transactions, valuations, and financials of private companies. We also have daily newsletters and other services, including the event. So we'll be basing the presentation today on the data that we've seen from the lens of the transaction database in the last 4.5 months. So the data is updated till May 15, so the scope of this presentation is going to be to that. And wherever possible, we're going to analyze and project and see how the rest of the year is going to hold up as well, based on what the last 4.5 months have been. So usually we start the presentation with investments for the year till date, but this time we're going to start with exits till date, because we don't want to miss the elephant in the room, and you'll soon find what it is. So PE-backed IPOs, right, the biggest driver of exits in the last couple of years. In the last 4.5 months, you see the numbers there, right? Like there are only 9 IPOs with about $1.4 billion in terms of PE-backed IPOs, compared to the previous year of around 30 odd and 8.4 billion, right? So there's a significant dip in the public market exits with all the global reasons that I mentioned. And if you see some of these IPOs, they've been one renewable energy company, and all of these, if you see, they've been in the first quarter per se, right? So overall in the exits, if you see, it's about 20% of the last year till date. And if you project it, it's still going to be less than the previous year, right? Both in terms of volume and value. By deal type, while public market exits, relative to the other type of exits, strategic sale and buybacks and so on, is still considerably the largest, like the previous year as well. But in terms of value, you see it's much less. It's only about $3 billion compared to about $11 billion. And even the public market exits that we've seen here, they've been mostly post lock-in expiry sale in the public markets in companies like Grove and Lenskart that got listed. We'll come to the investments side of the things. In terms of investments, I think both in value and volume, we've been holding up. We've been sort of tracking what we did last year. If you project it, it'll probably even surpass what we did last year in terms of volume, and probably match or mildly surpass last year. But if you double click and see what's sort of holding up within the numbers, with the you see, sorry, the quarter that's currently undergoing, even if you project it for the full quarter, we're falling short, right? So we'll have to watch very closely as to how this quarter and the next is going to pan out, whether it'll help surpass. The first quarter was good, but the second quarter is sort of a little down. And in the last 4.5 months, we've seen 3 unicorns. And as you see, Skyroot, NASA, etc. there, so which is also signaling a new trend that's happening this year, the emergence of deep tech companies growing with scale, right? With that, I would also like to, draw your attention to IDTA members that are there in the room. Sudhir, Sethi, who's helped put it together, and Arvind Mathur, sir, who's taken up the mantle at IDTA as well. You would have enough opportunity to network with them. And P investments by deal size, year till date as well. 30 investments. It's not very visible from here, so I'm a little bit struggling with the. Yeah. Okay. Thank you. This is helpful. Superb. So yeah. So 30 investments. If you analyze it, it'll be probably matching the current year, and the average deal size is also holding up at 28 million. But again, if you double click on the average ticket size, it's not the median, right? It's the average. So there's one very large deal, the RCB IPL. So that's a large deal at $1.8 billion. And followed by a couple of data center deals, again, noting the trend of deep tech and AI indirect play on that as well. Again, by industry split, there are no surprises. The usual suspects, IT, ITES, and BFSI continue to hold a significant part. Again, the outlier is the sports and fitness in this. Telecom, what is showed as telecom is the data center deals that we just saw. In terms of stage, you see growth late stage continuing with smaller proportion. Buyout continues to be dominant. Again, the RCB deal, there was a revenue cycle management deal, a couple of deals in the buyout stage that's showing this good proportion. Early stage is relatively lower, but I think if you analyze it, it'll probably make up. Growth stage is probably not going to match if you analyze this number yet. Looking at the fundraisers by the VC funds and PE funds, Again, 4.5 months, this is not too bad in terms of 30 funds. If you analyze it, maybe triple it, it'll surpass or hold up to last year numbers. $2.8 billion again, maybe around the last year numbers. But if you see the VC funds, the volume probably 15. If you triple it, it'll probably be close to about 45, 50. But the amount is only $500 million. So this is maybe indicating that there are a lot of smaller funds that are getting formed. In terms of individual funds, if you see, most of the funds that have been raised is indicating private credit. As you may know, private credit is the flavor of the season as well. That's holding up. And VC funds, bunch of smaller funds with smaller fundraisers. So more volume there, but smaller fund sizes overall. With that, we can take a look at what the forward-looking view is going to be from the panelists. And to start the day, I would request Mr. J. Rupani to speak on asset allocation models for the Indian family offices. Jay Rupani is the head of Dinesh Hinduja family office, where he oversees investments across all asset classes for the group: real estate, stocks, bonds, structured products, private equity, and venture capital. He oversees strategic initiatives, including financial education, succession planning, etc. Mr. Rupani is also the founder and chairman of IKEA Connect, an investment network for single family offices. Previously, Mr. Rupani was an investment banker at RBC Capital Markets, managing tech IPOs and M&A. He also served on the investment team at True North, a private equity firm leading significant investments in companies like Merucabs and Act Broadband. He holds a BBA from University of Michigan and an MBA from University of Texas Austin. Without further ado, sir, please.
I think they have me live on. Yeah, there we go. Oh, very good morning. I didn't realize venture intelligence had so much security. I drove in, I said, Jesus, Arun, who have you invited? Yeah, I said, मैं तो खाली यार, I'm a simple LP family office guy. I don't need 16 armored vehicles and big shots, and you really picked the right day for this. So jokes apart, there are a few friends in the audience, so great to see everyone again. And I think before we jump into the presentation, and I'll just request the team to put up my presentation. I think we all first need to probably just breathe. It's been a rough year. It's been a rough few months. India, is almost feeling like what my friends in China were feeling. So I did a short trip with about 20 family offices to China. And we met some of the biggest guys, 10 billion, 20, 15 billion invested last 20 years. And I asked them, wow, you guys are like really welcoming us with open arms. What's going on? I said, nobody loves us. What's going on? Nobody loves us at all. Where did you guys come out from? Under which rock is India coming to China to see what to invest into? Right? So I almost feel like we are in a bit of that pain mode, but things to change. And crude hopefully will get back to $60 and our economy will breathe again. Right now we are at a choke point. And one thing that life has told me is in the last 30 years of me living as a professional, first 20 I was, like they said, doing maja as a kid, is that, this too will pass and we will all be fine, right? So let's just take a breath. And today my role is very simple. I wear multiple hats and I'll walk you through a few slides. And the goal is to also keep the room open to questions, right? So let's dive straight in. Before we begin, I'd love to know who's in the room. So if you could just raise your hand, don't be shy. It's good to stretch. Those, not like this, please. Full hand, please. Right? So how many GPs in the room, please? Okay. We've got about a handful, a little more than a handful. How many LPs in the room, whether it's family office, institutions, etc.? We've got a few. Excellent. Uh, how many folks who help the ecosystem run, whether it's lawyers, accountants, etc., etc., right? Awesome. Great. And any founders, entrepreneurs? Lovely. Great. Super. So, how many, and last but not the least, the favorite question, who wants to raise family office capital? There we go. Okay. Excellent. So, let's dive in. I just want to make sure I'm addressing the needs of this audience. So, I wear two hats today. I lead investment strategy for our own family office, which is the Gokuldas Exports family. We built India's largest garment export house, sold it to Blackstone in 2007. And for the last 20 years, we're managing our own private capital. We are actually three family offices, three brothers, so three family offices. I represent one wing. I represent Dinesh. Along that journey, roughly about 5 years ago, I realized that family offices are first of all, unique. It's a new word in India. It's evolving. Historically, and even today, a lot of large businesses still host it within their CFO office. It's not really given its own private capital because, let's face it, if I'm an industrialist making 23% ROE, which fund is going to tell me 23% ROE har saal le lo? Maza aayega, right? I mean, come on. So I'm obviously going to put all my eggs in my own basket that I control rather than give it to others till I have a liquidity event. But 5 years ago, we realized that this room needs its own private space. And hence, I took the leap to saying, can I create a not profit-driven venture called Ekya Connect? And Ekya Connect is a single family office investment network. It's by invite only, and its minimum threshold is about 1,000 crores for anyone to be a member. And today, God has been kind. We have 85 families from 6 countries and 16 cities who are part of it. We curate and host events throughout the year to bring them into private rooms and for having private conversations. And the goal is for them to learn from each other because they're always getting stuff from outside. But they're always confused also, right? Because it's not about only money. It's also about my next gen has just come back from Harvard. My father is 79. He's still holding on to the reins. I'm 52. Should I just retire? Since he's decided that succession will happen at 92. So मैं क्या करूँगा? By 62, I don't want it. It will jump. So a lot of us are in that envious position where you say at 50, my job is over. My son who's 32 will actually inherit everything. I'm just the free float. Right? So jokes apart, these are real, these are real questions. And sometimes these are questions that you can't answer outside. And so our goal was that, can we create a room where we can discuss capital, discuss allocation, plus all the needs of the family office, right? And I say a lot of it is blessing from above, where we have been able to bring this curated audience together. And today my goal is to share some of the insights from that for the benefit of this audience. So one of the things is capital is definitely institutionalizing, right? This is no longer 50, 100 crore type. Okay, I have it on the side. I run a 1,000 crore company. Let's do 50 crore of investing. Let me talk to my friends, figure out 1 or 2 startups, figure out some funds, put some public market stuff, right? This is getting serious. The fact that we have 85 families in 5 years with us, all above the 100 million mark, tells you that this exists. So this is what we have seen as part 1. Step 1 is what was earlier known as 45 families is now 300, it's probably 500 and going to about 1,000. Everyone from across the world wants to come to India to raise money. Apparently, we are the writing checks. We have Silicon Valley coming in. I get calls from all the guys, global guys. I say, what are you doing? Why aren't you raising in New York? I said, boss, it's too hard. It's too hard. I'm not being able to raise my 40 million because they're also small boys. They're the guys who have not been able to break into second, third funds, right? So we are also seeing very interesting shifts that globally people want to come to India to raise money. And I'm looking at them, yes, people have money, but please understand this is a different animal. This is not your, they will ask you 50 questions, they'll call you for dinner, they'll want to call you every 3 months for something or the other. Please understand the animal you're going to partner with. But that said, sophistication is also coming in. Teams have been built. Today, it's not uncommon. Every 2 weeks, I have a call with somebody who's sold his company 1,500 crores, 2,000. And he says, boss, I don't know what to do. I'm an industrialist here. I've got 50 calls from vendors to this, to all the wealth guys are banging down my door. I said, go on a holiday. Take me along. I'll also come. You need a first 30 days so you don't pick up anyone's phone. Take that phone, throw it out of the window. Say, I'm not available. I just made money enough for the next 5 generations. I'm out. Go relax. Answers will come later, right? So there are also people who are trying to figure out. And now, if I had told earlier, say 5 years ago, I told somebody who had exited a 2,000 crore business, and you will need a 5% team, assume a 4 crore spend, 4 to 5 crores. They'd look at me and say, you mad? I pay my accountant 25 lakhs. Huh? 25 से 40 लाख में वो काम कर रहा था. Okay. He ran my industry. 1,000 crores. उसके बाद एक CFO था, ठीक है, 75 lakhs. Why do I need a CIO at 1.5? Like, what are you mad? Today, the conversation is completely different. Jay, tell me who I should hire. Because I want to take my business to $1 billion plus. So I know this capital needs serious names. So let me help. So I like that. I like the fact that we are all, and this is relevant for all of us, that this capital is no longer, I would say, dumb. It's trying to do its best to be smart. Now, I want to leave some points with you guys in terms of how does this capital think? So it's not a fund. Okay, we are not yet evolved. Yes, anybody who manages more than I would say 500 million in India has about 10, 15 people on its rolls. The $1 billion guys run it as a private equity shop. There's no doubt about it. But most of the other guys, who even if they're in the 100 to 200 million, a decent amount, is capital preservation. So I think when we're talking to them, I think you have to first acknowledge the fact that they're entrepreneurs. Two, acknowledge the fact that they don't want to go back 50 years to day zero. Nobody who's made 1,000 crores in his life wants to hear, I shaved off 250, or be the uncle that wrote that check. Right? These are real issues. Behavioral science came out of that, right? Investment behavior is also psychology. Second is multi-generational. If anyone goes into that room to have a conversation, I think very important to ask is, who am I talking to? Is it the CIO? Is it the principal? Is it the next gen? So you have these multi-stakeholders. So let me give you a little bit of insight. When you go and meet a 70-year-old patriarch and you're a private equity shop, what do you think he wants to talk about? He doesn't want to talk about your IRR or DPI. He doesn't even know what DPI is. He's like, boss, I'm worth so much. How much do you need? His brain is saying, all his life, he has only been called for what? Sir, sign kar lo, sir. Sir, aapka sign chahiye, sir. Khadam karo. And he has made 95% right decisions, 5% bad decisions. He knows that's how it works. So he is taking a call on you and your ability to get the job done. That's what he had success with. And he's trying to see, if he backs you, what is he going to get? Is he going to get intelligence? And the ability to. He's happy. Is his next gen going to get a friend? He's happy. Is he going to be invited to special dinners? Even more happy. Right? So now you take that to a CIO. CIO is sitting, he's sweating. He's holding on to kursi. Now, what should I do? This is a new fund. Kid looks promising, but I also have the other funds who've been around for 4 vintages, right? Do I control the fund? No. Is it a black box? Yes. So so think about these factors as you go in, right? How are you going to build trust with the person behind that seat? Our next gen wants to know what events you are doing for them. So each stakeholder needs a very different approach, and it's very important for you to, when you walk in a room, to understand who's that stakeholder. Now, God bless you if you're sitting opposite me, because I wear all three hats, which means I'm complicated. But most other ones are easier, right? And you also realize that the last point where it is asset allocation is real. People do certain things for certain reasons. They have an illiquidity quotient, they have a bucket, respect it. They also are, remember, like Buffett says, right? Never lose capital. So number one keeps flashing up. Even as they're talking to you and getting excited about deep tech, they're really wondering, aisa wapas aayega? They're not worried about, honestly, they're not worried about the return. They will tell you, of course, I want 28% because my business gives 28%. But the reality is they are more worried about, ki, boss, will I have loss of capital? Because loss of capital is a very deep cut. So let me share a little bit about what do most family office portfolios look like today. Still today, it's about 50% is public markets. I would say on the alternative side, we are reached about 10 to 15%, some less, some more. Real estate is interestingly not a very big piece. Some of us who have legacy real estate, it's a large piece. For most people, if you tell them, have you bought, will you buy a building in BKC for commercial rent? They're not so enthused. Today with the REIT market and InvIT market, you really don't even need to go there. Global and offshore is actually picking up. So interestingly, people are seeking those conversations. And like Hari said earlier, private credit, for example, has suddenly become the flavor of the year because equities haven't done well. A certain other, even private venture still has some more glory days, right? So what are people seeking now? Returns, cash on cash. They want some kind of cash return. They don't mind holding. Everything has risk, they understand, right? So suddenly cash and fixed income has become a larger piece. Let's talk about PE and VC because that's a big topic. PE, VC, 10 to 15% of the allocation. Preferences move towards late versus early. And it's interesting how this pendulum swings. I'm in LP in 12 funds. I've also dealt with my own emotional baggage. And I have a lot of friends who are GPs. I was a GP myself. So I understand the game. And it's hard. It's very hard to be a GP because you have to react to the market. You are trying to create products that have either only seed, then A, then B, then all, then khichdi. And the reality is not your fault because you are listening to the institutional LPs, you're listening to the family offices, you're listening to your distribution partners in wealth. You are trying to figure out how do I, see, your goal is what? I want to invest here. I remember as a fund manager, I said, boss, I'm least bothered about fundraising here. Don't put me there. 25 years ago, I was like, boss, I'm not interested in that side. I want to do deals. So it becomes a bit of a challenge because you need to raise the money to do your work. And so I think understanding even the journey of how family offices land up in this game. I've sat with promoters who are still running the business but have become chairman and have been in AGMs with me saying, I put $1 million in 5 funds. I go to the AGMs. I'm trying to understand this space. I don't know like where it is, but theek hai, I'm learning. So they look at it as instead of going to Harvard, I don't have time to go to Harvard again. I'm 60. But it's like a Harvard education. Kar lete, right? So, there's a whole, you have to figure out when you talk to the family office, where are they in the journey? Are they doing angel investing? Are they co-investing in club deals? Have they done hopefully a few fund investments? Are they co-investing with funds? And then obviously the holy grail that interestingly, which I don't really buy into, unless you're of a certain AUM, the holy grail is I want to do my own deals. There's pride in that. It's a lot of pride. And I'm on the opposite side of that trade. I don't want to do my own deals. I much rather do it with Sudhir. Because I know he's got 32 people in his office, making sure we don't lose money. Right? So these are the realities, right? But not everybody thinks like that. They want to be on the dining table telling them, I put 2 million into this and it's going to rock. Till it doesn't. then you remember, then people remember you for life, right? So those are the burdens people carry. A lot of times people ask me, what will it take for me to raise money from this? And really, what it will take requires us to step back from who we are and what we want. Let's figure out what they want. So what is the role of that fund or as a founder, my direct invest request? What is the risk? Let's be honest with them. And there is a risk. This is not all going to be perfect. How are we mitigating that risk? What is the liquidity? And in the end, how do I build trust? This is the hardest part. I'm selling a 10-year product, 12-year product. I'm selling my dream game. How do I build trust with them, right? How do I get that thing? So hopefully I can help here. Since we have very few LPs, I'll briefly touch. This is my own personal view. As I said, I'm on the other side of the fence. I don't think LPs should do directs unless they have money to throw away. They say, I'm writing off checks for a Stanford MBA every year. It's okay. 200, 300, 500K, it's okay. My next gen is having fun. He's out of my hair. I'm building a 2 billion business. Life is good, right? But the reality is, family offices don't always get the best deals. Why should they come to you when all our friends here on this board are much bigger and smarter? TVS, Takeboat, Chiratae. Really, what check size will I write that Sudhir can't beat me to it and give better terms? So the reality is, there are, so I keep telling my friends, I said, don't get so excited about directs. There's a governance overload, you need a team, you have a bandwidth issue, you will get notices, God forbid there is a fraud, then happy journey there, right? So these are things that happen. So I will skip this since this is, we have fewer guys here, but I think this is an important one. And these are again, things that really matter. And these are my own personal beliefs. If somebody comes to me with a fund, I'll ask them, what is your alignment? How much money are you putting in? A lot of times I find it a bit scary when the fund says, sir, for you, I have a 25 crore allocation. I say, how much are you putting as GP? Yeah, mandated but to 5 crores, we're putting 5 crores. So excellent, what is your net worth of you, 3 partners? If I understand, if your net worth is 15 crores, you're putting 5, respect. If your net worth is 100 crores and you're putting 5, I got a problem. Right? So these are hard questions that even now, be ready. Most people, these are family offices going to ask these questions because they want alignment. If the ship goes down, are you going to burn with it with me or am I holding the bag? Right? Then fund size. The fund sizes keep growing. Does the strategy merit it? Those are questions that we ask. What is the demonstrated edge? So I was sitting with some SEBI guys at an event. And they said, today, sir, so I said, what's happening? Why you, so many AIFs? What's going on? I said, sir, no, it's a good thing. It's very good. I said, damn good, okay, but that means 1,600 knocks on my door. What's going on? Why? So he said, we were 400 5 years ago. Maybe 6 years ago, we were 400 AIFs. Today, we are 1,650 AIFs. So really, the question is, what is your demonstrated edge? If you are not within the first 5 minutes telling me how much skin in the game, de-risking, and your edge, you lost me. I'm like already checked out. I'm having chai. I'm enjoying my cardamom tea. Saying, thank you, lovely. Right? Second, I'll give you a live anecdote. DPI versus IRR. The family offices are investing into funds. Why? Because obviously they respect the fund manager. They understand the process. They understand portfolio construction. They realize they can't do it. It's not their cup of tea. Which means what? I'm banking on your strength and your forward-looking guidance to exit when the time is right. I had 2 portfolios, two managers, 2 portfolios, 2021 happened. One person got off the train on a deal and return 30% of the. It was a hot transaction. I called him up. I said, boss, this is the hottest thing since sliced bread. You sold 40% of the stake. You are a new fund. You are fund one. आप क्या कर रहे हो? What is this? And I couldn't. I mean, sitting here saying you should be riding this train, yeah. What real money is made in after 8 years. This is only year 5. And his thing was, I have 4 more funds to raise. I would like to show that I'm giving money back. I said, you're the boss. I've handed anyway the reins to you. Aap karo. To his credit, 40% sold then, 40% sold a year later, and 20% sold later. And he made a 7 to 8x, 9x. Overall, he would have probably made a 16. Now, on the flip side, I had another fund manager, 21, who said, this is hot. This is amazing. We're just going to stay on the gravy train. This is awesome. 21 came, 21 left. I was straight holding the bowl. There's nothing here for me. Now tell me, who would I bank? Who would I give money to in the next round? I'm going to give money to the guy who's saying, I respect your money is equal to my money, and I don't want to lose it. I want to ensure that you get to see some money coming back. Now, this could be a one-off anomaly, right? Typically, most venture guys, I also buy it. You have to hold in, you have to stay. As long as you have visibility to the growth, it's great to stay. But I have found this piece to be very interesting, is where young fund managers have taken the effort to actually send money back and saying, it's okay, maybe I won't make I'll make a 4.5x. I may not make a 7x. It's okay, but I want to build a trust that I am a capital returner, right? The other thing is also behavior in distress. Not every deal goes right. How do you communicate? Do you go quiet? Right? Are you visibly setting up a call to say, I'm going to discuss this deal crashed, and not just burying it for the next 9 months till the next NAV discussion, right? These are important. See, the one thing that's going to take the longest for anyone in this room to make is trust. Everything else is given. Everything else you can buy. You cannot buy trust. Trust is built. And when it is built, it's built with transparency. It's built with the reality of saying, I am vulnerable. Yes, I am wrong. Except I screwed up. We do this in corporate, right? What do we tell our teams? It's like, step up. If I'm the lead, my team screwed up, I screwed up, right? So why can't we have that same ethos, right? So I think these are small touches, right? And then real co-invest, right? Remembering people when things happen, right? So just to add to that point, where real co-invest, what has befuddled me is the fact that LPs have been looked upon as just pockets of capital without intelligence. If you are today running a $500 to $1 billion fund, making 2%, that means 20 million, $10 to $20 million in top line, you're in good shape. If wealth managers appoint RMs, don't we need RMs? As fund managers, shouldn't we have a dedicated vertical to do family office outreach, management, and care? What does it cost to hire a nice, sophisticated, clean-looking person who's got knowledge? It could be some of the internal team members too, but it's got to have a mandate. It's got to say, I'm going to look after this group, because this group is actually the coal that goes into the fire. It's not happening. Very few top firms. Today they're talking to me. A lot of the big guys who've raised few billion are now struggling on Fund 7, Fund 9, saying, money's drying up offshore, I need domestic capital, what should I do? So can you please come on our advisory board? Can you guide how we should change this? We're ready to invest, because we are generating $50 to $100 million in fees. We can spend it, but we don't know how. We don't know what we should do, and how do we bring the teams to give us buy-in? How do we get my managing partners, who are always fund managers, who want to do deals, to say, hey, listen, man, I got to also look after the pot that feeds us, right? This is a 20-year plus game. This is not a light game. So these are nuances that are reshaping the way even fund management runs. Coming to where the LP-GP relationship breaks down, right? LP engagement. I touched upon this earlier. I think it's very important to identify the stakeholders and actually engage with them, and to give time and to set a separate team for this. I know when you're a small fund, it's hard to do. But as you get bigger and bigger and more vintages, it's the way the future is. India has a lot of wealth. It has an entrepreneurial spirit you cannot imagine. And I would say venture and PE are at the cross section of saying we can build businesses together, right? So if you keep that mindset saying, we're going to take you along on the journey of investing, you will have a very different response, right? The one other thing which I know my GP friends don't like me for is fees. I said 220, in my view, is a Western philosophy. If India takes 12 plus 2 to harvest, you can't be doing 220. Yes, if you're giving me money back in 7 years and you're giving me a 34% IRR, bro, take it. Net IRR, not gross. So, please understand the challenges of India. Who's telling us we don't have to fight among the GP community? I'm sure 2-3 new models of fees can be done. And there have been guys who've been very successful creating 0.3, 115, or only carry and only fee. So I'm saying be creative. You don't have to follow the world. I think silence in hard quarters is a big one. I think communication is key in any game. So where is family office capital going? One is going global. I think today Indian businesses and Indian families want to be seen as global citizens. When you look at the returns offshore, you look at the returns onshore, you look at aspirations, you look at next gens that are studying abroad, you look at the social networks, the business networks. There's no reason that you got to stay here and live here. You could be Indian by just origin, but capital will eventually find its way to the best spot, risk reward spot. So I think that's shifting. Also, families have realized that they want, rather than doing 10 funds, they want to do 3 funds. They want to put bigger checks. They want to engage deeper because they understand. If I put a small check, obviously the GP has only so much bandwidth. He's always going to give the bandwidth to the top 10 guys, 15 guys. So can I move up the capital stack? Those are very important, right? Next gen at the table, for sure. Don't discount the next gen that's sitting on the side, sometimes not talking because Pop is taking the limelight. Sometimes the next gen's conversation post-event post-conference is actually important. So you should be talking to that kid who's sitting on the right as well. A lot of club stuff happening, right? At IKEA, we have noticed one of the reasons even IKEA was born was because we realized we need intelligent capital networks. And people want to have private rooms to talk about these things. They need to discuss, hey, are you looking at infra? If so, which funds are you looking at? Who do you like? Have you invested? Right? The first threshold, even in IKEA, so people are not allowed to share things within IKEA unless they've invested within it. So if I say I'm going into infra and I say I've invested in X fund, then I can talk about it. I can't just say, hey, I like this guy. These people are great. Because the first question any family office asks the other guy is, have you put money in there? And if the answer is no, they will strike you off. They say, boss, this guy's a waste of my time. There's no strength. वो खाली बात करते हैं. So I think it's very important. Collective intelligence is becoming very important. We do a lot of stuff within IKEA to bring that in. The events, the closed door lunches, dinners, etc. We don't have to talk about it because it's very bespoke. The horizon is 20 years. And it is getting serious. With that, I'd like to pause. And lovely to be able to be here. And thank you, Venture Intelligence, for the invite. I have my colleague here, Megha, who leads strategic partnerships at IKEA. So If you want to learn more about IKEA, unfortunately, I have to leave for another meeting. But would love to continue the conversation. My email's out there. I can be found on LinkedIn. Yeah. Happy to take any questions if there are. Thank you. Very quiet room, यार. Coffee नहीं पिलाया क्या? बोलो. Thank you.
Jay, you talked about the fees. So you got this Muhammad Ashford says it's 2 and 20. You said there's some other model. Could you sort of elucidate on that?
Sure. So what I have seen work well for a few funds is where they are. I think this is. XYZ a 50 crore, 100 crore check, then I give my institutions the same thing. I'll give you. That is the MFN clause, which most PPMs have, right? They say, I'll give you the most favored nation. Everyone gets the same fee, which I respect again. Now, what I'm saying is actually to break a mold. Because, especially when you talk to family offices, see, I come from being an investment banker, private equity guy, so I understand 220, I understand the model. Sometimes that's bad for me because I'm not dhanda investor, right? Because I'm come from that space, I'm accepting it. You talk to some of my other friends who sold a 2,000 crore business, and he says, how much money do you need for the 10 people you hire? So they go cost basis. I said, boss, it doesn't work like this. He said, I don't care. How much money does it need? Okay, it needs 10 crores. Done. So at just if you raise only 100 crores, then of course it's too high. So it means you will be 1,000 crore fund, then it's 1%. Right? So they are actually happy to, and I find it funny, but it's the way it comes to that crux of saying what is the right structure. So what I have found successful in a few funds is people saying, let's really forecast this, right? If I raise 2,000 crores, I need to return 10,000 crores to make a 5x. And after the waterfall, fee and carry, you will get a 3x. And a 3x in this much time is a 16% return or whatever. Now, I think somewhere along the line, you have to get to the point of saying, what does that principal want? And some principals say, listen, I want zero, I'll give 3% full fee, but no carry. I'm not going to profit share. A fund has raised more than 3% fee, zero carry, half and half, 1.5 and 15, or spread. Right now, what is he doing? You are catching the investor wherever he because anybody who's on the edges is the outlier. Right? A distribution will show that you cannot run the business at zero fee, right? I mean, you have to run a shop, travel, get to the right deals. So I think sometimes these special programs work. Can I do a program for your next gen? You are worth whatever. Let's say you are a family office. 27. He's why can't you do that? Right? But yeah, it comes at a check size, which is also different. You give me 15 crores, your next gen can work for 2 years. And then he he'll go on his own journey. And he will go, and he can bring 50 crores of co-invest. So you see how you break out of the standardized molds and get to what end goal is. End goal is I need to raise my money, I need to do my work. These are things that you will have to invest in, and you'll be surprised. Don't discount the guy who says, I don't know this asset class. Worth 2,000. Gets trust and he sees the growth. You'll be shocked. You say, I love it. I want to do this with you. In check. Just because they trust, right? It's a flip of the, you have to get into the path. So I hope that. Please.
It took 24 months for me to do a hard bargain deal. And the times, I mean, it looked like we were in two different time zones, right?
Yeah.
So, question again is that they suffer with a lot of sunken loss fallacy.
We take a portfolio approach, right? So we are very clear that not everything is going to win. Even with our investment team, when we talk about any deal, we say there's going to be things that don't go well, right?
As a founder, how do I deal? Because 24 months is too long for a founder.
Yeah.
They don't understand.
Yeah. No, it's hard. It's hard. I think it comes down to knowing. And sometimes, and this is another lesson from my hard knocks of my own life. Not for them. And because this always happens, especially as a founder, you will find people who will be. Customer. Step out and say, thank you. We'll meet for a cup of tea. Diplomatically, leave and find the next guy. Right? What you're asking for is for them to convert. It's like talking to my 85-year-old grandmother who says every morning, God bless her, she has better blood than me. Right? And she's having ghee and she's having this paratha, and I'm looking at her and saying, I'm 50 and I got cholesterol. He ain't going to change, man, at 85. I should just take her blessings and move on. Right? So, true.
So, what kind of government policies plays a role in? So, do you think what government new policies are and basis that you invest money, or is it like just go with it?
No. Honestly, we look at that, but is it a determinant? Of course, I mean, if it's like solar and there are certain concessions, of course, and I'm putting a big check. So I have to preface it. Certain sectors will have that, certain sectors will not. But you've got to have a holistic approach, not just government. I think we're time, right? Yes. So thanks, everyone. Thank you again. Pleasure seeing you. As and when you need. Thank you so much.
Family office allocation. I hope a lot of you have taken away 2 points from that.
Coming up is the inaugural panel focusing on the macro issues, the macro view. We invite on stage the members of the inaugural panel.
Amit Sachdeva, Managing Director, AlpInvest Partners. Kumar, Founder and Managing Partner, Ascent Capital. Krishna Ramachandran, Managing Partner, TVS Capital Funds. Sudhir Sethi, Founder and Chairman, Chiratae Ventures. Skanda Jayaraman, Managing Director and Co-Head, Investment Banking, Ambit. Daksh Trivedi, Partner, AZB and Partners, the Moderator. A bit about Daksh's background. Daksh Trivedi is a senior partner at AZB and Partners, one of India's leading corporate law firms. Based in Delhi NCR, he specializes in corporate M&A, private equity, VC, business transfers, and fund-related matters. With more than 20 years of experience, he has advised both listed and unlisted companies across sectors such as pharma, healthcare, specialty chemicals, telecom, real estate, IT, mining, and e-commerce. He has also worked extensively with the private equity and hedge funds on investment strategies, FDI, and fund formation matters, along with advising on online gaming and technology-related legal frameworks. Daksh completed his LLB from the Campus Law Center, University of Delhi, along with a diploma in International Trade and Business Law. He also holds a Bachelor of Commerce degree from Sri Ram College of Commerce. Over to the panel, Daksh.
Good morning, everyone. Welcome to this inaugural panel of the PVC Conclave 2026. I am Daksh Trivedi. Thank you for that introduction. Over the past 20 odd years, I've had the privilege of advising funds, corporates, and founders over a spectrum of private capital transactions in India. And it is my pleasure to moderate this session today. At least in my view, I think none of you need. At least in my view, I think none of you need an introduction, but for the sake of formality, if I can request each one of you to say a few words about yourself and your firms, please. I think, Raja, why don't you start?
I'm Raja Kumar, Ascent Capital. Ascent invests in mid-market investments, and we typically lead rounds in Series B and Series C. Recently, we concluded, we led the rounds to the extent of 70-80 million in 4 deals. And thankfully, we have good access to high-quality deals.
Thank you, Roger. Sudhir Sethi from Chiratae Ventures. We invest in venture and we invest in growth, but focused on technology and technology-enabled companies in the Indian ecosystem.
Good morning, Krishna Ramachandran. I represent TVS Capital Funds. We are about 18 years old and we are a rupee-only fund. We raise money only here. I know the market's not doing well. Everybody feels a little low about everything else, but I want to cheer up 2 investments that we did this year. Both were unicorn, NISA and NEO. So I think there are still a lot of opportunities in the market. So I want to start this with a positive note. Yeah.
Good morning, everyone. My name is Amit Sachdeva. I represent AlpInvest Partners. AlpInvest is a limited partner in the private equity world. Been in existence for about 25 years, 100 billion plus of assets under management. And what we do is 3 things. We invest in managers, private equity buyout shops globally. We invest alongside them. So we co-invest, and that's the business I run in Asia. And we also have a secondaries platform.
Hi, my name is Skanda. I co-head the investment banking division at Ambit Capital. Ambit has been a premier investment bank that has been around for over 30 plus years, but now is a full-fledged financial services institution from banking, broking, wealth management, asset management, as well as we have a lending business as well. On the investment banking side, our mandate typically is, to provide capital solutions on the private and public market side. So we start with Series B and then go all the way till companies get public and their life cycle beyond that.
Okay, thank you. Thanks, everybody. I thought we could basically start with a broad question. What is on the top of your mind? I know, uh, 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 Krishna, you've already sort of set the stage by saying that a little bit of disappointment, but yeah, silver lining that you are doing really well. So, what is on the top of your mind in terms of both opportunity and risks in the current environment? Uh, and at least for me, particularly, the general India investment thesis of the demographic advantage that India has. Do you think that sort of overrides any of the challenges that we have currently? And Raja, would you like to start? And is the fundraising environment? Sorry. No, so I was just sort of going to complete a specific one for you to say that is the fundraising environment currently the most challenging that you've ever seen?
Sure.
Yeah, fundraising was never easy at any time, right? And different vintages, different challenges. Talking about the current situation, we all expected after LP's disappointment in China, we expected a higher allocation to Indian GPs. It has not happened, and there are very many valid reasons. And typically, when we approach foreign LPs, we used to spend enough time on speaking macro. We had a lot of positives to talk about India macro. Now we avoid talking about macro. Recently, I was there 2 weeks back, and all that usual claims of fourth, fifth, sixth GDP and demographic advantage and etc. All that I don't want to repeat the same thing. GPs have been talking that for long. Biggest challenge is currency. One will wonder that India never had, rarely had surplus on current account. So we primarily depend on capital flows, right? It is known to everybody. In that case, why do you go so wrong in tax policy and lack of clarity? For example, I was a taxman earlier. Taxing Tiger Global is completely unjustified. It has sent wrong signals. How can you go back on grandfathered situation? How can you go back on reneging on treaties that has to be respected? It's very important for a foreign investor. So these things have happened, and I also partly, I was on the other side as a taxman, as a SEBI, as a regulator. I often, now I'm on the industry side, I have no hesitation in blaming the association or industry body. When they go to a policymaker, they should go as a stakeholders. They're stakeholders for this country. They are earning most precious foreign capital. They're creating jobs. 15 lakh crores of capital that this industry has with them, and they put in long-term job creating, tax creating situation, how much clout they should be having to tell the policyholders to do it right. Unfortunately, this industry body fails again and again, highly disappointing. They don't go, they don't advocate, they don't write, they don't create the valid points in the media, and they don't appear as stakeholders for this country. Otherwise, why is that we are going wrong on attracting capital flows? Without capital flows, there are no reserves here. Without capital flows, there is no balance of payments. Without capital flow, there is no currency stability. And from there, many problems will start. It's all known thing. Okay, we have FDI, we have API, and we have remittances. All will hold back if it is depreciating. Coming to domestic capital, I'll be very quick and other stuff. Domestic capital, institutional base is still small, and retail money, unfortunately, India is the only country, to some extent, Israel, who went allowed retail money into alternatives. I was an opponent of it. I never 1 crore floor is very low. It should be 10 crores or 20 crores. There's an inherent mismatch between long-term holding required. The retail guys won't do that. So, but industry went big time into retail money, and it comes with its own cost. It comes with its own challenges. So, to conclude, that fundraising is taking longer time, expectedly, and for valid reasons. And but you need to remain optimistic. And whenever my optimism is low, I reach out to Sudhir. He, he, Ascent is somewhat old-fashioned. We raise money, we pause for a few years deploying it. Then after 3 years, we come back again to raise money. But smart ones like Sudhir, they're constantly raising money, constantly investing. And he's a guy, I must say him is the eternal perpetual optimist, I think.
No, thank you. I think that's very insightful, and I think you raised a good point about the policy issues that we are facing. And I think one example that comes to my mind immediately is also the online gaming industry, and what's happened to that given the.
Can I add two data points
Yes,
to what he
please.
said? I think last 2-3 years, the fundraise globally has been seeing a downward trend in the private equity and VC globally. India has beaten the downward trend. You would also have seen in 25, numbers are much higher than 24. So that's one data point. I think it was visible today morning when you presented this. The second data point is, I think last year in 25, 66% of the fundraise was from domestic fundraise. Money had come in. So there's enough money in the domestic pool that's coming in. It's harder to get it. You saw the opening speech by Jay, how smarter family offices are getting and institutions are getting smarter. So it's harder and the journey is longer to convince them to invest. But there is money coming in and we have beaten the global trend to increase. About 400 odd first time managers have set up funds in the last 3 years. These are very positive numbers. But it's difficult because you're now actually maturing as an industry. And also the investors are maturing and they're able to ask the right questions and challenge you. Right? So that I think that data point is relevant. So it's tough, but we need to work harder.
Yeah, that makes sense. Absolutely. No, I was just finishing my point about the online gaming industry, but pessimism aside, Sudhir, given that you got this reputation of being the eternal optimist, let's have your views on this.
So I must say that Raja and I have a back scratching agreement, which is very good. We've learned together since 1999, I think. But look, I think there are no new points. We actually celebrated our 20th year this year, and there's 2013, one of our LPs just taught me with a hammer, and that LP said, whenever I come to you, you only talk about investing, and you never talk about exits. This was very big learning. And he also asked me, who's your customer? Thankfully, I replied that my LP is my customer. And we have to provide value add to entrepreneurs, but LP is our customer. And then we took a decision that what will hold us good for the next 10 years. And the only thing, and this is in consultation with our investors, the only thing which will hold us, and I quote my LP, tell us you know how to exit, because India has not returned capital. And this is 2013. So we decided at that point to exit. TVPIs will get depressed, IRRs will get depressed because the time for holding time is longer. COVID really depressed everything because that was a very major event which happened. Net, if you ask us in summary, what does Chiratae stand for? We stand for exits. We work hard to value add to our investors, to add value add to our entrepreneurs. Entrepreneurs are, we get lucky to back stellar entrepreneurs all the time. India will give us that opportunity a lot. But net, we said we will return again and again and again. So now we've returned for 15 years in a row. And this year, we're trying to predict return on a quarterly basis, not on an annual basis as such. We've invested $1 billion, we've returned $1 billion. Indian markets will go up and down, like every other market. Indian markets will have policy issues, and I agree with Raja, there are big policy issues. But Indian markets will continue to do this for the next 10 years. We've decided we'll invest in India, and we have to make sure that the investments give returns. And I think Jay pointed out very nicely. We've taken a decision since 2013, we will continue to return capital. And to me, that's very, very crucial because we cannot manage, we can try to convince policymakers, but we are not the guys who do the policy. So we have to run our businesses to make sure whether family offices or structured programs for co-investments, international investors continue to get returns from India. In a sense, what happens then is, then with this, let's say, game plan, you actually find the right investors who believe in that game plan. So if somebody comes and says, look, I think I'm looking for 30% IRR, my answer is very simple, we're not the right guys overall. The second thing which we have done is very interesting is, and I think we are seeing the results of that, is we've layered programs to make sure that returns do increase. This is, we have a risk-adjusted asset classes now, venture and growth. We are adding secondaries down the line. Different people run the businesses so that there's no conflict. We've got a very strong co-investment program. And to that extent, we are also looking at whether we can now go into separately managed accounts. Fundamentally, there are pools of capital who have different goals and different expectations. And governance plays a huge, very, very big. I mean, we've seen frauds in some of our companies, but yes, we strengthen our position in that and go forward overall. So I think I'm excited about India. There's no question about it. Fundraising is difficult. Exits are difficult. Retaining people is difficult. Exits are very, very difficult. But I think you put your head to the ground and every VC fund, every growth fund will do better and better. India provides that opportunity to do better. I want to focus on one thing. We've tended to focus since 2007 only on technology and technology-enabled businesses. We don't know how to do infrastructure. We don't know how to do anything else. And I think that market is a higher risk and it's a higher return market. So I truly believe that, we just invested in a company building data centers in outer space in the early stages. We invested in a company building 3D rockets for low Earth orbits. We invested in a quantum company. We are invested in a robotics company. So we will continue to do this. And we believe now, especially with the RDI fund coming in, and some of you will know the RDI fund, which is a sovereign intervention in India for deep tech, because deep tech was enabled in US and China in a area of capital abundance, whereas deep tech was growing very slowly and many companies used to die because follow-on capital was not there. I think that is changing right now, slowly. It's very early. It's on day one right now. But it's a 1 lakh crore, $11 billion fund. And private markets are supposed to add another $11 billion, 50%. And I think IDTA, Arvind is here, they will hopefully take care of that. But fundamentally, it's a $22 billion intervention in the market space. Right. That is huge. That, in some sense, will, for VCs, and VC, by the way, globally, is tech. 70% of VCs is tech. So I think we should look at that in a very positive arena. And there's a lot of learning which we have to do, a lot of engagement with the LPs. Because especially in India, we have, out of our 1.3 billion, about 5,000 crores is from India. There's a lot of engagement with LPs because many of them don't know the depth of it. And it's that engagement which will, I think, pay off. So opportunities, more capital from India. I think more capital from outside. Many of us have not worked hard enough outside the country to raise capital. We need to have separate people to do that. More opportunities. opportunities in technology, very clear. There's no question. The kind of entrepreneurs we are seeing is amazing. And consumer is still the big chunk, right? It's not just deep tech. Consumer is still the big chunk. Fintech is emerging overall. So I think you'll see the market growing. There's no question. Whether it grows as 10%, 15%, or 5% is an annual affair. I don't think we should get bogged down by that.
Very, very insightful. Thank you, Sudhir. I think I definitely want to come back a little later in the session, on your comments about exits, and I want to deep dive into that and ask you what are the sort of challenges that you're facing over there. But Krishna, to you, and I think Sudhir has pretty much covered all the basics here. But I mean, what are your thoughts, and particularly if you can also overlay, the AI challenges that India is facing currently. I get a recurring YouTube reel where it's the messaging that comes through all the time is to say that India has missed the AI bus, etc. So, I mean, what are your thoughts on that?
Yeah. I think just to extend a little bit from what Sudhir said, I think the opportunity to invest in manufacturing / industrials is very highly understated at this point of time. Because if you look at the private equity space, the top is financial services, tech, IT, then financial services, healthcare. Somewhere in the 4th or 5th rank order, you get the manufacturing. But also, if you look at the exits and the returns, if you look at the other table, you will see manufacturing is nearly equal. So it's kind of pacing the returns as well. So I think it's a very understated, underexploited area, and we are actually looking at it very actively, especially areas which are components, electronic components in defense space, specialty chemicals. There's a lot of opportunities there. I think that's a area one should look out for, like in addition to what he said about infrastructure. AI, I know you preempted this question, so I was thinking, because before I joined here, I used to be CFO, I used to run operations. In a particular year, I want to go back in time, and we implemented 300 bots, what we call today agents, which AI was called bots through RPA, robotics process automation. Just a quick information on that. So we said, I presented in forums with API, representing Allianz or Philips, saying AI is going to come, RPA is coming in a big way, jobs are going to go, it's going to get automated. But between 2010 and 2020, about 800,000 jobs got created in GCC in India. Between 2020 and 25, 600,000 jobs got created in GCC in India. It's a fact. And 2020 was kind of a peak of the RPA. Same time, I think the IT industry has also added about 50% more than the annual addition in that decade for here, right? UiPath is a star kid in the stock market. In 2020 was listed at $38 billion. This today, $6 billion. I'm not saying negative about AI, please don't get me away. I'm just trying to give you experience that we have all seen with RPA when it came in and what we thought will happen and where we are. The second point that you clearly asked is, have we missed the bus? We never miss the bus. We give volume and scale, which no other country in the world can give. We are the second largest user of AI tools next to the US, anywhere between 6 to 10%, depending on looking at Claude or ChatGPT, right? ChatGPT, we have 100 million users. That's not a small number, right? And we had the AI summit last year. About 20 governments represent us, and all the company CEOs were here. Largest AI conference anywhere in the world. So what do we give to the world? We give them scale. We will not give them a Claude, but we may make something like Perplexity sitting in the Bay Area.
Right. And Krishna, does that cut into our edge in the tech and BPO services sector? Do you think that's the case?
Absolutely. See, I shared the forum for RPA with the founders of Automation Anywhere 10 years ago. Right. And he said, China is the manufacturing capital of the world. We are the service capital of the world. The amount of BPOs that we had here, we there. So the process knowledge, service knowledge, the amount of contribution that Indians make to GitHub is unparalleled. So that potential will obviously be there, will be unleashed. So we have to look at operation of scale, where we can contribute in scale where we are. If you IP a product, the valuation is significant. But this is more like a Gini's quotient, right? It spreads the wealth, creates more. And that's what we need in India, right? To spread the wealth, create more jobs, more people. And we offer that on a platter to the world. 144 million people are going to be coming to the employment category by 2050 from India, where every other country, including China, is not able to produce employable workforce. It's a great power that we have.
Can I just mention one point? I think this AI issue is very important. Can you hear me? AI is very important. And investors like us, we actually learn from our entrepreneurs. Absolutely. They're on the cutting edge of everything right now. AI being implemented, investing in AI is a foregone conclusion. If it is there, people like us will invest, people like TVS will invest. But I think the very important part is how is AI being used to improve the efficiencies and productivity of existing organizations. And what we've seen, and one of our companies is executing AI for the last 6 months actually. There are 30 war rooms right now in every aspect, from logistics to manufacturing to, you can name any function, marketing, sales, etc. And these 30 war rooms meet every day, by the way. How to get AI implemented so that the financial benefits of using a technology is over a period of time. And it's working. Two of our companies have already implemented this in marketing. One company had a team of 40 people. Unfortunately, job losses are happening, but we'll address that separately. They have now, I think, 2 or 4 people, right? And the productivity of marketing per rupee coming in has shot up overall. So I think it's very crucial, whether it's a steel company, whether it's an infrastructure company, logistics company, manufacturing, e-commerce, the use of AI, low-hanging fruits are so big. It is important to make sure that value which has already been created gets to the next phase of 2x value being created through the use of AI technology.
Understood. And sorry, just to keep this flow going, Sudhir, and I'm so sorry, Amit, Skanda, I'm taking a lot of time to get to you, but you've been sort of, through the innovation technology cycles with your vast experience at Chiratae. What is it that's so different about AI as opposed to the, say, previous telecom, internet, mobile transitions?
Shorter life cycles. Cost runaways can be very high. Intelligence is so high. Net, all of us are using Claude and ChatGPT, etc. I mean, my personal productivity has shot up by 40%. I never saw that earlier. So I think there are many benefits at personal level, at organization levels. What needs to be done is you have to, our thing is, can we be a tech VC, and are we using technology as a VC? Now we evaluate about 3,500 new companies every year. And I think 40% are being impacted by AI-based search. Those models are being built within us because we as a VC, today we are 30 plus people, right? If our AUM doubles in the next 5 years, we can't be 60. It is not possible. People are very difficult to get. And by the way, VCs have to turn younger every year, right? Because beyond 45, 50, very difficult to understand technology. You need the younger generation to come in. So I think there are many changes which are going to happen. The biggest is that everything which we do in a product using some technology, whether it's commerce also, the life cycle is so short, you have to move faster. And that's the only way. I was reading an article how speed adds to GDP, right? Very interesting. Speed adds to GDP, rapid turnaround times. And that's a it's like speed adds to GDP is like 1 rupee in 4 months. You turn around, or you turn around 1 rupee in 1 month, right? That is very possible in today's world without experienced people coming into it. There's technology who can do the low-hanging fruits initially. 40% of that can be used by technology. There's no question about it.
Thank you. With apologies, Amit, thoughts and I think a little bit more specifically, what are your thoughts and how are you deploying capital and sort of advising clients right now?
Yeah, so maybe I can provide a LP perspective. Obviously, good to hear from people on the ground. But just taking a step back, if you think from a global allocator's perspective, India is never been a core market for all these global platforms, right? And it probably will not be the core market because, unfortunately, the sad reality of the world that we live in is that US continues to be the dominant market and will so. And in the present market environment, while US may have had certain issues driven by Trump's presidency and Liberation Day and whatnot, it still continues to be the largest market. We cannot take that fact away. So what I'm trying to say is, while the audience in the room obviously has vested interest in the country and we all want to do more here and we all, have been investing in this part of the world, if you think from an allocator's perspective, every dollar that gets invested in India from their pocket is a dollar that is not invested somewhere else. So it's always a question of risk return on an adjusted basis. How much are you willing to deploy in India versus other markets? And today, to sort of address your earlier question, from a global perspective, while US may have had lost some sheen, it's still the dominant market. That's where I would say 50 to 60% of the capital that any global investment platform is doing will be deploying. Europe has become very attractive. That's the other market that, while US may have gone down, today we are seeing very interesting opportunity from Europe, driven by the fact that a lot of European countries are realizing that they need to be self-sufficient and not depend on other markets. They have to sort of spend in their internal economies. And that's what's creating a lot of interesting opportunities. So while there may have been some pullback from the US, Europe has taken that slack. Now, if you come to Asia, again, India does not just compete with emerging markets. India competes with the whole world. And even within the Asia allocation, today the sad reality is markets like Japan are the markets that people want to invest in. So what I'm trying to say, long story short, yes, India is an important market and we all have vested interest. But if you think from a global allocation perspective, it is not the core market and will not be the core market, at least for the near future. So that brings to what needs to change, because I've been in the industry for almost 20 years. And when I started in 2008, it felt sort of very similar. A lot of PE shops doing minority investments, every person looking to raise, some kind of private equity fund, but the track record wasn't there. So it then goes back to the same point. You have to deliver. From an investor's perspective, it is what matters. Returns, how much money you have generated for your investors. It goes to the point about how efficient you are in terms of managing your gross to net spread. Exits are very important. That's been a pain point for this market for many, many years. Yes, it was better in the last 2, 3 years. Probably not so going forward that much, the dependence on the IPO market. But the GPs here have to realize that at the end of the day, they have to deliver money back. You cannot have paper gains, you have to have cash gains. And that is dollar denominated. So unfortunately, it's a sad reality that we all have to face. But there are managers in this market, and some of them are on this stage, who have actually delivered returns, and that's why they are able to raise capital. So even in today's market, again, sorry to digress, but even in today's market, we are seeing a clear demarcation between haves and have-nots globally. While the average fundraising time has gone above 2 years for any manager, there are managers who have raised successfully in one close in 3 months, 6 months, just because their track record is good. And that's what we need to get to, right? So it's just a long way of saying what matters from an institutional global platform perspective is returns, because that's what we need to answer to our ICs sitting in the US or Europe, wherever they are. And that is the key question that people ask. Why do I need to invest in India when I have good opportunities somewhere else? And we need your help, the GP community here. We need your help to justify why India should be a part of that allocation strategy.
Thanks. I think that's very, very interesting. Skanda, let me sort of preface that with the cute questions. How many of your deals, or would you say majority of your deals, are they stuck on valuation?
No, it's not. Look, I mean, I think it depends on which part of the market you're talking about. Secondary blocks, of institutional holders, definitely, I think there is a delay, right? People do not want to, go on a fire sale when people don't see the need for that to happen. On the private side, I think it's very sectoral, I would say. We are seeing a lot of deal closures happening in the InvIT space, InvITs in the REIT space. And basically, again, if you have to weave a theme across sectors where there is healthy operating cash flows and where there is capital efficiency, we're still seeing deals close, right? This is the growth stage and the late stage, right? I'm not talking about the early stage. Financial services, for example, has seen a huge correction, right? So there are two ways to look at this and actually say that look, financial services is doomed. I don't think that can ever be true because we are still a credit-starved country, right? Valuations are very attractive at this point in time. So I think capital will start to flow back in to financial services, right? So now, yes, there is a bit of denial at this point in time in FS on let's say what is the right value at which you will value, right? And there are people are reacting to it two ways. One is people who are very well capitalized actually have the luxury to wait on. People who are not so well capitalized are actually taking a very interesting approach of saying that, you know what, if you have to come in um, at a valuation that is very attractive to you, either offer a profit share or you pump in so much capital into my company now that my growth is taken care of for the next few years, and then they know that when actually the market comes back in a couple of years, valuations kind of catch up, right? So the short answer to that question is, look, I'm not as negative to say that, look, valuations are the reason why deals are stuck. I still believe that it just presents very different kind of opportunities. Companies who want to go public now, companies that should not have gone public in the last couple of years, and companies that should not be looking at or they're subscale, they will start to reevaluate it, and that will give more opportunities today to growth capital, funds to come and invest. Number one. Second is secondaries is a very, very active opportunity, right? So we still don't have too many allocators, playing very actively. I see a lot of international funds flirting with the idea of doing secondaries, but there's always this bid-ask spread because people always want to buy 20 cents or 30 cents to a dollar, but nobody's selling at that price, right? But then I think that gap will definitely close as more and more high-quality businesses they have a fiduciary responsibility to give their GPs an exit or their funds an exit. But at the same time, the fundamentals of the business are doing well. So I think I can at least see a lot of activity coming in on the secondary space on the private side. So I think it's a bit of a, if you take a capital across public as well as private, I think it balances it out. Maybe public market transactions will be a little slow.
Understood. I think that's a
Maybe,
good.
Daksh, I can
Yes,
to
please.
sorry, just on the secondaries point, because that's obviously an area that we play globally. It is becoming massive. I mean, the secondary market continues to double every 3 to 4 years. Today, it's close to $200 billion. Just about 10 years back, it was not even $100 billion, right? So it's a massive opportunity that is becoming even bigger. And India is quite behind. I mean, it's catching up. But 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 if you think from a perspective of, again, there used to be a stigma behind secondaries 10, 20 years back, especially in this part of the world. That stigma is gone. So while you may not want to sell because you don't want to take a discount, but actually, as an LP, I would highly recommend you considering the opportunity that the secondary market is providing today, because it's a very valid and a very well-established, well-understood tool to manage DPI and liquidity for your investors. Which is, again, it goes back to my earlier comment. Returning capital is very important. Yes, you have to generate good returns, but you have to get money back to the investors. And secondaries, whether it's GP stakes or CVs, whether it's single asset continuation vehicles, multi-asset continuation vehicles, these are very well established tools globally that GPs in India are definitely they should be looking at and embracing, because it is a very credible way, especially when the public markets are not showing the kind of robustness or the frenzy that we saw in the last 2 years. This could be a very viable tool that people should be looking at to get money back to their investors. It's very important.
Right. Sudhir, sorry, just on.
I think a year and a half ago, the tax regime changed. Listed stocks where capital gains tax was half of the unlisted. Now it's same. Right? So that context has to be seen to see what is the interest in secondaries. Because at the end of the day, as a fund manager, if I want to do secondaries, I want to make sure that the net cash to my investors is protected.
Correct.
So now that is equated. So I'm sure there will be a lot of interest in secondaries now. That's why you're seeing the surge in secondaries interest in India.
Now, Sudhir, I just wanted to come back to the original exit point that you had made, and does this sort of tie into what you have in terms of your exit strategies from funds which you said was critical to be delivered to your investors?
Sorry, what ties up?
The entire secondary market.
Okay. Yeah, no, I agree with Amit and
yeah.
Skanda also. So our exits have been 66% secondaries, 17-20% IPOs, and balances M&A through 18 M&As that we've done so far.
Right.
Out of the secondaries, 2 have been multi-asset secondaries, and hopefully a third one now. So completely agree in terms of the various market is getting mature. I think regulation, as Raja mentioned, is a little bit behind. For instance, LP secondaries, difficult to do in India overall. We've done LP secondaries in the international fund side, 2 of them. So markets will mature. There are so many funds in the country. I think Jay mentioned 400 AIFs. Out of this 400, I'm pretty sure a bulk don't have exit experience. So that's a market which we go and look at whether it's a single asset or it's multi-asset or it's cleaning up the fund, offering CVs. I think that market is maturing very fast. It needs that capital. There are international players who do this, but I agree with Skanda that they come in with a mindset of 30 cents to the dollar, whereas people like us in secondaries in the market will go and say, how can I add value? And secondly, how can I get my returns? I mean, I'll be very happy if I get 30 cents to a dollar, but then I'll question whether that transaction is worth doing or not. On a good deal, if I'm a seller, why would I want to sell at that level? Secondary markets are going to grow very fast right now. But there are very less people in the country who actually have a buyer secondary experience, right? Most of the people are sitting in Singapore. And so I think India will need to build that pool of expertise in terms of people who understand how to do secondary transactions. That's very, very less right now. Most of the secondary transactions are happening at the pre-IPO levels. But at the mid-market level, it's very few right now.
Got it. I think as a lawyer, it's very strange for me to see so much consensus, but great going. Raja, to you, I wanted to ask, the LP profile in Indian AIFs has shifted considerably over the last few years. How is this changing what GPs can and can't do in terms of investment horizon, sector focus, risk appetite, and return expectations? And to finish that off, are we seeing LP preferences actively reshaping portfolio construction?
Yeah, that's a perfect question. I think we should step back a little. Fundamentally, this asset class is LP centric, not GP centric now, right? It's LPs who decide. Globally, 500, 400 LPs through ILPA. Matosab is here. So they regulate the GPs around the world, right? So LPs, their business and for them, by them, and they play a very active role in the governance and they shape the fund strategy, a way to invest, not to invest, and fund cycles and all that. So it is true that in Indian context, like my panelist said, that today AFs out of 15 lakh crores, maybe 12 lakh crores for the AF 1 and 2 strategy, presumably long term, right? So, and who are these LPs who back this money? And to a large extent, maybe 60%, 70%, Krishna, what do you think? Is retail money? Retail and family office?
I think third to half is institutional.
Yeah, so remaining mostly family retail. Yeah,
large family offices and HNIs.
Yeah.
So
together 60-70% is the. So this pool of money has come for the first time, and typical of our asset class is illiquidity, and so we have to see how much time these guys wait for deal with that illiquidity of 7 years, 8 years, or even longer. To my mind, it appears that will actually shape the portfolio that GPs pick up. they want to show DPI, so mostly late stage investments will happen, pre-IPO investments will happen. And also, if I have a choice as a GP that I want to have a capital unfettered, that I want to earn a particular multiple and I want to earn carry, to that I want to be unencumbered by anybody's. If like in India, for example, if I take some institution's capital, I have to implement their strategy. If I take SIDB money, if I take RDA money or whatever it is, I have to do 2 times their strategy. So I have to meet that strategy. At the same time, I have to earn the returns for the overall fund. So this is something which is a limitation, right? And so coming to the point, whatever it is, the T20 that we want to play in India is different. The T20 that elsewhere, right? If you say when you go abroad and talk about venture capital, private equity is buyout, venture capital is long-term investors, pension funds, endowments, and they take in specie and they want to stay with the winners, and it's a game of different rules, right? When I say the same asset class here, the LP profile has changed. I'm not saying good or bad, it has changed, right? So we have no choice but to cater to that LP base. So the more late stage investments will be easy, that is earlier to liquidity will happen. Then my friend already before the session, I was talking to Sudhir. I entirely agree with him that the phenomenal scope for secondary funds in India, and especially there's so many investments going to be made by 1200 AFs. So there will be massive liquidity. So there's a wonderful opportunity for secondary. So secondary, like my friend said, Alp, and then no, secondary is good. It gives liquidity to the original investor, but secondary is the return potential is limited for the first time investor, right? If I can make my company IPO, if I can make strategic exit, my return potential is high.
Got it.
If I'm selling secondary, naturally the discount. And one more point I would like to add for all of us, again, which I would like to touch upon. These things by now should have been addressed by this industry, right? When you are going to sell secondary exit, crazy indemnities will be asked for. Okay, the same old indemnities and tax indemnity, other indemnity, other indemnity. And why? By now, industry should have sorted out because there is nothing new. Nobody want to avoid tax here. These things should have been sorted out. And you are a lawyer, you know. And if you're on the other side, you will insist on those indemnities.
Absolutely.
If you're on my side, you will bat for me. But collectively as industry, by now, I mean, too late, 20 years and still you fight the same issues as an iBanker, you know, right? And more indemnities and more discount. First of all, finding a buyer is difficult. Then after that, all these things will come into play. So then last point I would like to say that um, the for a few more years to come, that the cross-border funds who are raising capital from the typical long-term LPs, they'll have an advantage and they will invest in VC style investments in India, and that will go for company building on long term of 8 years, 10 years. Now, recently I've seen with my friends who are VCs, and some of their companies have really discovered after 10 years. It took them 10 years or 12 years, and today they are becoming unicorns. Okay, many other fellows could not have hold that investment such long period, right? So this is the dynamic, and so Indian market has changed so much because of the LP profile. So the game we are playing is very different. It is not the typical venture capital. It is not the typical private equity. And so those long-term family offices also, I have a feeling, they will invest in late stage. They also will go for controlled investments, more buyouts, because many families are retiring, like Rupani said. So the change is constant. I could see that the way it is changing. So the entire game has changed, and we have to adapt.
Thank you.
Yeah, just a point to add, I kind of plus one on the family offices kind of. I mean, their entire priorities have changed because in 2021, 2022, as recent as that, if you look at where they were allocating and where the velocity of interest was coming into, they were very interested in backing a lot of the early stage tech companies because they, a lot of them felt that they wanted to be part of there was FOMO to do that. Now that wave has not, kind of panned out. So therefore now they have gone the other way, is to say that either we will go and back very, very large, companies and assets ourselves and take more stable bets, or like Raja said, make direct investments, organize ourselves, build a professional team, and go make direct investments ourselves and take even controlling stakes, right? So the next generation of the family kinds that are there are no longer in the traditional businesses that their fathers or parents were. They rather are managing the family office, so to speak, and then that has changed in terms of being able to leverage a group's capability to operate, plus the financial wherewithal to attract a certain kind of talent. So they want to actually go directly into investments and operate.
Understood. Sorry, Krishna, you want to say something?
Just I want to just share a couple of my experiences in the last 3-4 years where I've been very actively raising money. I think what has changed in the last 12 months in the LP, one is the PFRDA and NPS money that's coming in. It's about 32 lakh crores of money that's going to get unleashed in some percentage. So that's a fact. It's already done. Raman is working on that. It's happening. So that's a new pool of money. The second pool of money is the insurance companies with LIC. It's close to about 70 lakh crores of AUM. A fraction of that which they're allowed to invest as per IRDA is still not being met fully. So that is still significant potential to come in from the institutional side for India, which is there. On the family office side, I think today there are shy of 1,000 structured family office, like what Jay was speaking. In that area, what we see is that if you go and do a deep research out of their private allocation, somewhere between 30 to 50% of their private allocation is gone direct into companies. So therefore, the co-investment, right, despite the regulatory challenges we still have, and we're trying to solve them, is of great interest to large family offices, significantly large. So you're seeing a lot of family offices are cutting out large checks for co-investments. That's a big change you're seeing in LPs. So LPs want to come and ask you, can you show me deals which I'm not able to see from the founders directly? Can you show me which is coming uniquely to you because you're early stage or uniquely to them? The third is the high net worth individuals. Data to be consumed here is 10 times increase the number of tax filers with 1 crore plus income in the last 5 years. So that's the pool that is, so the LP base is actually changing from that point of view within the domestic. I raise only money in India, so I can only tell you about what I see in India.
Right, interesting. I mean, I think just coming to you, I mean, what is the deployment strategy that you have? How is your in-house team structured? And I think in your view, what are the key drivers of success in LP direct investments?
Well, in terms of our allocation strategy, frankly, I sort of touched upon it earlier. I mean, if you look at our platform, whether it's fund investments, secondaries, co-investments, no matter how you look at it, we have commingled funds, we have SMA accounts. So across everything that we do, we'll probably do about 50 to 60% of our deployment in the US market and about 30 to 35% in Europe. And then in Asia, we'll do about 10%. And within Asia, we have a bias towards developed Asia. So roughly of that 10% in Asia, I would say 6 to 7% will go towards the markets of Japan, Australia, Korea, and then the rest is basically meant for India, China, and Southeast Asia. Though Southeast Asia is actually probably not very meaningful for us. So that's been our historical deployment, and that sort of remains where we are. We have dedicated teams. We have 3 offices globally in terms of where our investment teams are based, New York, Amsterdam, Hong Kong. Each office has separate teams for these 3 strategies. So we sort of focus on each strategy, but we work collectively as a platform to support each other. So we obviously are looking to invest behind managers where we can then generate the co-investment deal flow that we can process as a direct investor. And we then also provide the secondary solutions that our GPs are looking at, whether it comes to, again, whatever secondary solutions. So we sort of provide that holistic solution to our GPs. In terms of our approach towards direct, and when I say direct, I mean co-investments, because we don't lead investments. We let our GPs lead those investments, but we are obviously providing capital and other sort of strategic benefit. We sort of categorize investments into, like, there are 4 broad areas where we spend a lot of time to understand whether it would make sense for us to add as a direct investor. First, it has to be a compelling deal setting. What that means is that the deal has to be in the GP sweet spot. We basically pay a lot of attention to what the GPs have done in the past, what kind of deals have they invested in, what kind of sectors, strategies have they, invested behind, and have they made, what kind of returns have they generated, who has done that. So we actually spend a lot of time as a primary investor before we commit. But that also provides a strong sort of insights into whether this deal is something that we believe that GP can execute on. So that's our sort of first gating item. Second, once we clear that, we spend a lot of time to understand the business itself. So while co-investors may come in as a passive investor, we actually do our independent sort of diligence on the asset. We spend a lot of time understanding the market dynamics, the whole value chain, where the business sits in the value chain, whether it can withstand pressures from its suppliers, competitors, customers, macro. Like we actually spend quite a lot of time to understand the business quality and the secular tailwinds or the headwinds that the business may be operating in. Then we look at a strategy which has what we call multiple levers of value creation. So for us, it's very important. Yes, it's good that you can find a company which can grow for the next 3, 4, 5 years at 30% top line. Great. I mean, that can happen. But in our experience, it's very difficult to underwrite. We like companies which have good combination of growth potential, but also some cost containment measures. Maybe it's a first-time buyout. Maybe the company is an asset-light model, so it generates a lot of cash. You can use that cash to pay down debt or do dividend recaps or do a regular strategy. It operates in a sector which is highly fragmented, so you can go after accretive acquisitions, so that you can build a platform. So we look at a thesis which has multiple levers of value creation, and those should be under the control of the lead GP that we are partnering with. So control is important. That's why our platform has bias towards buyouts. Again, unlike some of my fellow panelists, we focus on more mature companies, but that's where our history of investing has been. And then lastly, we do pay attention to valuation and capital structure, right? I mean, we're not bargain hunters. We're not looking to buy cheap assets. We're looking to buy quality assets, and we'll pay the price that is deserved for that quality. But we want to make sure that we underwrite an exit that we feel comfortable on. So if you look at our portfolio in the last 3 funds, almost 50% of the investments we have done as a direct investor, we have actually factored in multiple compression in our underwriting, whereas the GPs were not doing that. And that's not just true in India, that's true across the world. GPs were not doing that. Everyone thought that the music will not stop. But we were taking a view that we have seen this play out time and again, that the crazy valuations can correct very quickly. And as an investor, we were investing behind businesses where we were factoring in multiple compression. So today it's looking good. Our portfolio is looking very healthy. It's growing nicely. Despite the market corrections that we have seen in the last few months, our portfolios are accreting in value, so which is obviously helping us. So those are 4 sort of broad categories that we spend time as a direct investor, obviously leveraging our GP relationships.
I think I wanted to ask a few more questions, but I think we're out of time, and we need to also give some time to the audience to ask questions. But just to round this off, and maybe we can make this into a binary answer. 3-year outlook, and Skanda, positive, negative, neutral. What is it that you want to say?
Positive. Cautiously positive, but positive.
Yeah. Amit?
Yeah, cautiously positive. Yeah.
Okay. Krishna?
Minus Trump, very positive.
Are you talking about a Friday Trump or a Monday Trump?
I don't know. It depends on the time zone.
No, I think India is it's positive, no question. I just want to mention one thing.
Sure.
Indian capital in the last 3-4 years has started coming more and more in the late stage or in the VC stage. And I think it's a big opportunity for Indian capital, because foreign capital typically is in the mid-market and late stage. So I see it happen in China a lot, by the way. I see a lot of capital recycling and wealth coming back to Indian families and Indian investors through the exits which VC and co-investments are doing through foreign capital. Foreign capital typically does not take that risk. Foreign capital comes in, at a later stage as such. So I think that's a great recycling which is starting in India, which is at reasonable scale right now, which was not there earlier.
Next 3 years, VCs are the first guys to see the trends, and I expect a very new set of portfolio for the next 3 years. no longer SaaS and delivery apps kind of stuff, more AI themes and deep tech stuff, more late stage investments and more buyouts, and late stage deals remain costly.
Thank you.
One thing, sorry, for the benefit of the audience here also, because yes, as you raise capital or as you look to raise capital for your current or next funds, yes, you're competing with, whatever challenges have been in the market. But one thing I also would like to highlight to the audience here is the interest in China is coming back. As an LP, we see that very clearly. Now, in the last 2-3 years, India benefited from the fact that China was a market that many investors sort of shied away from. That's changing. And I do want to flag that to people in this audience, because that's going to be also affecting the sentiment towards investing in India on a relative basis compared to a market which, again, all said and done, is the largest PE market in the Asian context, and actually has delivered very spectacular results in the past. So I do want to flag that as a point to keep in mind.
Thank you. I think we can open the floor to any questions for the panelists.
My question is actually to Sudhir that if you
Sure.
take policy changes for the government, what would they be?
Two is a short number, I have many. But most important thing, you have to create a positive perception for currency, fundamental, and there should be stability in the way we treat foreign investors. That is number one. Number two, ease of doing in operations for the VCPs. At the time of investing, at the time of exiting, especially at the time of exiting, these indemnities are coming because of uncertainty of law, right? And for example, the tax indemnities, there's no way you can give that. You're exiting a company in the 8th year or 10th year, and you give indemnities for how many years? I mean, it's absolutely impractical. Similarly, secondaries, only the guy who is playing it understands how difficult it is. And it is very easy that to iron out these uncertainties, and as an industry, we can go and ask, and rather by department circulars, if they want to fix it, they can fix it. Trust me, I was on the other side. The government policymakers are equally smart, very quick in understanding. So it is the industry body who has to engage them in a particular way with sense of urgency. But we are all busy investing and doing our business, right? Not many have that proactive approach of fixing it. We are not asking we want to evade tax or anybody. Nobody is doing that. These are regulated entities and LPs govern us. I mean, we need to, by 20, 25 years, we have not ironed out these issues. So not two, there are many. And, but we can engage and get sorted out.
I can. I think at a macroeconomic level, I think we need to fast track EV and solar so the oil bill comes down. I think that will have a significant impact on how we manage our economy. And on the administrative side, I think the specialized tribunals that the government has created, NCLT and others, I think further strengthened to avoid the judicial backlog. Everything from a divorce to family dispute to a restructuring gets stuck in the High Court. So if you're able to move them and make those tribunals work independently and faster, I think our judicial system will actually bring in a lot more confidence for us. If I forget about foreign investors, I think we need to get our own problems solved faster. So I think that administrative reform in the judicial side is very important.
And there's a lot of movement on that, Krishna. There's, as far as AZP's advocacy is concerned, we were part of this entire scheme of decriminalize, the entire thing about under the Companies Act. So I think there are, steps in the right direction that are happening over here.
of any of the investment to exit, it close to 8 to 10 years. Manufacturing is even much more longer. So how does the panel kind of anticipate to do this irony bit? Because when you're talking from an investment point to an exit, the patience of capital and the kind of foresight to get a manufacturing story from an early stage investment to exit, it is very long. So how do you plan to tackle that challenge? Thank you.
I'll be short here. See, the way venture capital investors look at uh, any investment they invest, from the day one they're worried about who will buy that company. That is the single most point in their mind. And these benchmarks and valuations come from somewhere else. The SaaS index fell, and our SaaS valuations are low. Last 2 weeks, SaaS index went up again, and so the point is the VCs are aware of that, and they accordingly play, right? And so the productized services, of course, there is a niche play there. At an enterprise level, some products get built and all. I'm not saying it will be completely going out of fashion and all, but to a large extent, the benchmarks come from somewhere, and accordingly VCs play, because VCs are not. It is wrong on their part to expect everything will go for IPO. They are looking for other kind of exit. Other kind of exit is not easy. The buyers are so discernible. So the buyer is so thorough with their DD work and everything. Right? It's not easy to sell a strategy, sell a business to a strategy. So that weighs in the mind at the time of investing itself.
Thank you. I think the RDI fund with about 1 lakh crore rupees, I think will create a lot of opportunity for products from India. I think it's shown soon. See, manufacturing, in our mindset, we always think it's a steel plant or it's a refinery, right? Or a cement plant, and therefore you think of long gestation, 3 years and 4 years. Just unwind and look at even assembly level manufacturing. The PLI scheme is about 4 years old, and it's possibly one of the most successful schemes we run, right? And if anybody has been to the Tata Electronics factory in Hosur, which is now close to 80,000 people, right? And there are many others, right? So manufacturing is also, as I said, electronic component manufacturing, specialty chemicals. I think those are the areas to focus on within manufacturing. So supplies for defense and space. You've seen a tremendous boom when DRDO gave away its patents, and for commercial manufacturing, I think we've seen companies turn around in 3 to 6 years significantly. I think that works within the 8-10 years of the private equity space. So it's those areas. So you're not talking about private equity going and funding a POSCO steel plant or a JSW steel plant. We're more talking about these components which is there, right?
So, thank you for the amazing session. Speaking on secondaries, it has come out multiple times that this is a very growing asset class. So, at what stage should investors or founders consider a secondary rather than waiting for an IPO or a strategic sale, maybe?
Yeah, see, look, and this is something which I tell a lot of my clients as well. Typically, the average age for companies to go public, right? It used to be 8 to 10 years, and now it's actually going to about 14 years. And that's also because there is a reasonable depth of private capital which is available across their lifespan. And in fact, the later you go public, the better. Okay, so if you just keep that you put a pin on that. But then the question is, therefore, in the run up to that, what are your options from a secondary exit standpoint, right? Sudhir mentioned about pre-IPOs today. I mean, when you say pre-IPO, not to be mistaken as someone who only comes in during the anchor book. There are a lot of the funds who actually say that, look, it has to be a 2-3 year journey into IPO, so long as we have visibility into that kind of timeline. There is that. So look, I think there are enough options which are available. Typically, the short answer to that question is it's always a balance between the time, the vintage of your fund, how much time you genuinely have, vis-a-vis the optimization between the current currency rate and post tax, right? That typically uh, determines the velocity of the amount of. There is a lot of supply. There is enough people who are willing to get in and buy it. But like I said before, the bid-ask spread has always been the problem, right? And today I believe that will actually start to come together because there are more funds in the market today who are in the fag end of their life cycle, and therefore there is a need for that secondary to happen. And there is no certainty that the currency will not depreciate further, so to speak, right? So at some point in time, it has to come out in the market and people have to shake hands.
Can I just add one point? I think we have to view it from two. One is the fund manager and the other is the entrepreneur. From the entrepreneur's point of view, there's a discussion which happens on exits when the fund life is coming to an end. And it takes about 2 years for an exit to take place as such in a VC market space. So that discussion is a very straightforward, honest discussion because fund managers will face that and founders are the only people who they can talk to for that. So they have to do it together overall. And every company cannot go IPO. Out of 140 companies, we've taken only 5 companies and hopefully another 3 or 4 in the next 1 or 2 years. That is the ratio. Every company cannot go public. So if that reality check is very important for the VC as well as the founder. I think the most critical part, though secondaries are, a bulk of the exits right now. I mean, in Lenskart, we did exits 4 times or 5 times before IPO, right? In Flipkart, we did 6 times before the final sale. So why? Because funds have their life and we need to show capital return all the time. As far as, I think the crucial part is M&A. In tech, and I'm speaking from a technology point of view. Technology companies, the bulk of the exits are not going to be secondary or IPO. It's going to be M&A. And that's a very weak market in India right now. So, and we have time to develop that. We've done 18 M&As so far. And we believe that market has to be developed because there's no Indian buyers right now. Out of 18, only 6 were sold to Indian companies. Balance was US and Europe. So I think the discussion point is on that. That's a very big market as technology investments take place. And that market, if it grows with Indian buyers, I think technology investments will give returns also much more. And that depends on the quality of the company, capitalization of the company, markets being in India, et cetera, et cetera. So I think that's going to hopefully change in the next 10 years. M&As are not going to happen tomorrow morning. IPOs will increase, but much at a slower pace because it takes time to get. In fact, with technology, that 10 or 12 years is going to become 14, 15 years overall. So we have to take that into account.
For all your insights. It was very, very interesting. Thank you.
Very insightful session. Thank you.
Check. Check 1 2.